$450,000. Gone in 8 months. The email read, "We've made the difficult decision to wind down operations." David sat frozen at his desk, staring at the screen. Everything he'd saved for a decade, vaporized by a 26-year-old in a Patagonia vest. But how did someone like David end up losing $500,000 to a kid who barely knew how to code? You know what's absolutely hilarious about investing in San Francisco startups? The moment someone tells you they're disrupting an industry, you should probably just light your money on fire. At least that way you'll get some warmth out of it. Because here's the reality. Nobody wants to admit San Francisco has become the world's most expensive graveyard for investor money. We're talking about a city where 23-year-olds in hoodies convince millionaires to fund apps that solve problems nobody actually has. And the worst part, it doesn't just stay bad, it actually gets worse every single quarter. Before I completely destroy this Silicon Valley fantasy, hit that subscribe button. Because the next bad decision could cost you everything. And trust me, I'm about to prove exactly why San Francisco startups are financial black holes wearing Patagonia vests. Now, let me tell you about this investor. Maybe it was David. Maybe it was Michael. Maybe it's a composite of 5 different cases. Because here's the thing. This story is so stupidly common I don't even need to verify which exact victim I'm referencing. Did this precise case happen with these exact numbers? Who knows? But does it even matter when this exact pattern repeats itself every single month? This person, let's call him David, dropped $450,000 into a San Francisco AI-powered startup. The founder had a Stanford degree, a slick pitch deck, and talked about revolutionary machine learning, like he invented mathematics. David thought he found the next unicorn. Spoiler alert, he found the next bankruptcy filing. Just wait until the story shows up a bit later. It's absolute chaos. Let me hit you with some numbers that should terrify anyone with a bank account. 90% of startups fail. You've probably heard that statistic. But here's what they don't tell you. In San Francisco, specifically, the average startup burns through investor money 68% faster than startups in other major tech hubs. We're talking about companies that spend $40,000 a month on office space before they've made a single sale. The venture capital industry poured $86 billion into San Francisco Bay Area startups last year alone. You want to know how much of that will ever see a return? Industry analysts estimate that less than 5% of those investments will break even. 5%, that means 95 cents of every dollar invested, is essentially vaporized into overpriced cold brew coffee and standing desks nobody uses. And here's my favorite part. The median time for a San Francisco startup to completely implode, 80 months. That's it. A year and a half from we're changing the world to we're shutting down operations. But during those 80 months, founders will spend investor money like they're at a Las Vegas casino, except the casino has kombucha on tap and calls itself a collaborative workspace. Hold on to this number. The average cost to operate a startup in San Francisco is $375,000 per year. Before generating a single dollar in revenue. Now keep that number in your head because when I tell you David's story in full, you'll understand why this city is designed to bankrupt optimistic investors. If you've ever been tempted to invest in a San Francisco startup, drop shotgun in the comments. I'll leave a heart on every single one. Let's see how many people almost made this catastrophic mistake. Here's what they sell you. Picture this beautiful dream. You meet a charismatic founder at some tech conference. They've got the pedigree, Stanford or Berkeley, maybe MIT. They throw around terms like machine learning, blockchain integration, disruptive technology. The pitch deck looks like it was designed by Apple. Projected revenues show hockey stick growth. Conservative estimates, they say, suggest a 10x return in 5 years. They've already got a small team, a rented office in Soma with exposed brick and industrial lighting. They're talking to investors from Sequoia and Andreessen Horowitz. You're getting in on the ground floor. This is your chance to be part of the next big thing. This is how regular people become millionaires. They tell you, just look at the early investors in Uber, Airbnb, Instagram. You wire the money. 50,000, 100,000, maybe more. You get your equity percentage. You're officially a startup investor. Welcome to the club. Sounds perfect, right? Yeah, until reality shows up with a baseball bat and a spreadsheet in exactly 3 minutes. You'll see why this dream scenario turns into a financial nightmare for 92% of San Francisco startup investors. And trust me, the number gets worse the more money you invest. If knowing the ugly truth about San Francisco startups could save you at least $50,000 right now, smash that like button, because what I'm about to reveal will make you question every tech news article you've ever read. Let's talk about what actually happens after you hand over your money. Problem number 1. The San Francisco cost disease. That startup you invested in just signed a lease for a 4,000 square foot office in the financial district. Sounds impressive until you realize they're paying $68 per square foot annually. That's $22,000 per month, just for the privilege of having an address. That sounds cool. But wait, there's more. The founder needs to hire engineers. In San Francisco, the average software engineer salary is $165,000, plus equity, plus benefits, plus the free lunch program because apparently adults can't pack sandwiches anymore. Your startup needs at least 3 engineers to build anything functional. That's $500,000 in salaries alone before a single line of profitable code gets written. Problem number 2. The vanity spending death spiral. San Francisco's startup culture has convinced founders that burning money on aesthetics equals success. Your investment is paying for Herman Miller chairs at $1,200 each, a La Marzocco espresso machine for $8,000, catered lunches from Bayreuth Market, team-building retreats to Tahoe, a company retreat to discuss core values that cost $30,000. There are documented pitch decks where companies spent more money on their launch party than on actual product development. I'm not exaggerating! One startup spent $47,000 on a launch event with a DJ, open bar, and custom neon signs. They shut down 4 months later without ever acquiring a paying customer. Problem number 3. The competition apocalypse. Whatever brilliant idea your startup has, I guarantee you 15 other San Francisco startups are building the exact same thing right now. The market is so saturated that startups are literally competing to solve problems that don't exist. Companies routinely burn millions trying to differentiate products that are functionally identical to 7 competitors. And here's the kicker. The well-funded competitors will simply outlast your startup. They've got Sequoia money, they've got connections, they can lose money for 5 years straight while your little startup runs out of runway in 18 months. It's not about who has the better product. It's about who can bleed money the slowest. Problem number 4. The pivot plague. Remember that revolutionary AI technology your startup was building? Yeah, they're not doing that anymore. 3 months after you invested, they pivoted to blockchain. Then they pivoted to NFTs. Then they pivoted back to AI because that's trendy again. Each pivot burns 6 months of time and $100,000 of your money, while the founder pretends this was always the plan. Problem number 5. The exit illusion. They promised you an exit strategy, an acquisition by Google or an IPO. Here's what actually happens. After bleeding money for 3 years, the startup gets acqui-hired by some medium-sized tech company for $3 million. Sounds great until you realize the deal is 90% stock in a company you've never heard of. And after the founders take their cut and investors higher on the capital stack get paid, your equity is worth approximately $7,000. You invested $100,000 and got back $7,000. Congratulations on your 93% loss. Remember that case I teased at the beginning? David's story? This is where it gets wild. David invested $450,000 into what he thought was a revolutionary AI startup. The founder, 26 years old, Stanford computer science degree, had convinced David that their technology could predict consumer behavior with 94% accuracy. The pitch deck was gorgeous. The team looked solid on paper. David wired the money in March. By June, the startup had burned through $210,000. Office lease, salaries for 4 employees, and something called customer acquisition testing, which apparently meant buying Facebook ads that nobody clicked. David asked for a progress report. The founder sent back a 15-page document full of graphs and metrics that meant absolutely nothing. We're iterating on product market fit, the founder said. Translation: we have no customers and no plan. By September, they'd burned through another $150,000. David flew to San Francisco to visit the office. You know what he found? 3 people sitting on expensive furniture, working on laptops, looking busy, but producing nothing. The revolutionary AI was basically a Python script any college sophomore could write. The team of engineers was down to 1 engineer because the other 2 quit to join Google. In November, David got the email. We've made the difficult decision to wind down operations. After 8 months, his $450,000 investment was worth 0. The founder, by the way, immediately started another company. Different name. Same pitch. Same Patagonia vest. But here's the twist nobody saw coming. David started asking around. He found 7 other investors who'd put money into the same startup. Combined, they'd lost $2.4 million. And every single one of them was told the same line. We're disrupting the AI space. Every single one got the same gorgeous pitch deck, Every single one visited the same expensive office with the same Herman Miller chairs. The founder walked away with a full salary for 8 months, a nice resume line about founding a venture-backed startup, and immediately got hired as a VP of innovation at another company. David got a tax write-off and a very expensive lesson about San Francisco startup culture. Pause right now and drop. No way in the comments if this story just destroyed your faith in Silicon Valley. I'll leave hearts on all of them because, trust me, it gets even worse. Let's zoom out and look at the systemic disaster that is San Francisco startup investing. This isn't about one bad founder or one failed company. This is the entire ecosystem. The venture capital model in San Francisco is fundamentally broken. VCs know that 90% of their investments will fail. They're fine with that because they're playing a different game. They throw money at 100 startups hoping one becomes Uber. That one success pays for all the failures. But you're not a VC with a $100 million fund. You're an individual investor who just lost your entire investment when startup number 47 implodes. Here's what they don't advertise. The average venture capital fund returns less than the S&P 500 over a 10-year period. Read that again. The professionals whose entire job is picking winning startups perform worse than a boring index fund. And you think you're going to beat them as an amateur investor throwing money at some kid's app idea. The data is devastating. Of all startups that raised venture capital in San Francisco between 2015 and 2020, only 2.3% achieved a successful exit. Not a profitable exit. Just an exit. 97.7% either shut down or are stumbling along as zombie companies that will never return investor money. And here's my favorite statistic. The median return on angel investments in San Francisco startups is negative 46%. Negative. You're not just failing to make money, you're guaranteed to lose money if you invest at median performance levels. But wait until you hear why billionaires avoid this like the plague. Because while middle-class investors are getting destroyed in San Francisco startups, the actual wealthy people have moved on. They're investing in boring businesses that generate cash flow. Real estate in secondary markets. Index funds. Anything except gambling on 25-year-olds who think they're going to replace email. Now let's talk about something nobody mentions. The psychological destruction of watching your investment evaporate in real time. You check your email every morning hoping for good news. Instead, you get updates about pivots and strategic refocusing and challenging market conditions. You can't sleep. You're stressed. You're checking the startup's website obsessively looking for signs of life. Your spouse is asking questions. How's that investment doing? You lie, you say it's progressing. You don't mention that the company's Instagram hasn't posted in 3 months, or that half the team's LinkedIn profiles now list them as seeking new opportunities. The worst part, you can't get out. Your equity is completely illiquid. You can't sell it. You can't trade it. You're locked in watching your money disappear while the founder posts on Twitter about lessons learned and excited for the next chapter. Investors have developed actual anxiety disorders from San Francisco startup investments. Cases exist where people lost $90,000 and it destroyed their marriage. Not because of the money itself, but because of the shame, the embarrassment, the feeling of being conned by someone young enough to be their kid. Congrats. You just paid to have daily panic attacks while some founder adds entrepreneur to their LinkedIn headline. Smart move, right? If you've ever felt trapped by a money decision, drop a broken heart emoji below. I'll leave hearts on every comment because you're definitely not alone in this nightmare. Let's do some comparison shopping, shall we? That $450,000 David lost in 8 months, here's what else he could have done with it. He could have bought a rental property in Austin, generating $4,000 monthly in cash flow. That's $48,000 a year. In 10 years, that's $480,000 in rent alone, plus property appreciation. Or he could have put it in a boring S&P 500 index fund, historical average return of 10% annually. In 10 years, that $450,000 becomes $1.16 million. All he had to do was literally nothing. Just buy the index fund and wait. But instead, he invested in a San Francisco startup and got zero. Actually, worse than zero because he also lost the opportunity cost of what that money could have earned elsewhere. Here's another comparison that should make you physically ill. The average San Francisco startup investor satisfaction rate is 12%. 12%. That means 88% of people who invest in these companies regret the decision. Compare that to real estate investors at 67% satisfaction or stock market investors at 54% satisfaction. And here's an industry secret nobody talks about. There are entire companies in San Francisco that exist solely to help startup investors write off their losses. Tax attorneys specializing in venture capital loss mitigation. financial advisors who help you restructure your portfolio after getting demolished by startup investments. There's an entire ecosystem built around cleaning up the carnage. Law firms in the area handle an average of 200 cases per year of investors trying to recover something, anything, from failed San Francisco startups. Their success rate, less than 8%. Once your money is gone into a startup, it's basically gone forever. But wait until you hear why billionaires avoid this like the plague. Mark Cuban said in an interview that he stopped investing in early-stage startups because the failure rate made it statistically worse than playing blackjack. Warren Buffett has publicly stated he doesn't invest in tech startups because he doesn't understand them, which is billionaire speak from not throwing money into a bonfire. The actual wealthy people invest in boring businesses with proven revenue models. They buy companies that manufacture industrial parts. They invest in Midwestern HVAC companies. They're not gambling on apps that let you share photos of your lunch. So what's the actual solution here? How do you invest without getting destroyed by San Francisco's startup industrial complex? Simple. You don't invest in San Francisco startups? I'm serious. The data overwhelmingly suggests that unless you're a professional VC with a massive fund and the ability to absorb dozens of complete losses, you should stay as far away from this market as possible. The failure rate is too high. The costs are too inflated. The competition is too intense. The entire system is designed to extract money from optimistic investors and transfer it to landlords, lawyers, and founders who walk away unscathed. Want to invest in startups? Fine. Look at secondary markets. Austin, Denver, Raleigh. Cities where a startup can operate on 1/3 the budget of San Francisco and actually focus on building products instead of maintaining appearances. Or better yet, invest in small businesses that have been profitable for 10 years. Boring is beautiful when boring means you don't lose everything. The smart money has already figured this out. Venture capital investment in San Francisco peaked in 2021 and has dropped 41% since then. The gold rush is over. The people still panning for gold are the ones who haven't gotten the memo yet. If this video just saved you at least $50,000 in prevented losses, smash that like button right now, because understanding this reality is worth more than any startup pitch deck. So, here's what I need you to do. Tell me in the comments what shocked you most about San Francisco startup investing. Was it the failure rates? The psychological damage? The fact that billionaires avoid this market entirely? I want to know. And I'll leave hearts on every single comment because these discussions matter. Subscribe if you want the ugly side of wealth and investing exposed every single week. No sugarcoating. No motivational garbage. Just the brutal reality of where money actually goes to die. Share this video with anyone you know who's thinking about investing in startups. Send it to your friend who keeps talking about getting in early on some tech company. Send it before they wire money they'll never see again. And if you think this was brutal, go binge the playlist, Why Being Rich is Horrible. I'm warning you right now, it's addictive. Every video exposes another way wealthy people and wannabe wealthy people destroy their lives, chasing status and returns that don't exist. Next week, I'm exposing why investing in Dubai real estate is even worse than San Francisco startups. Spoiler alert, it involves frozen bank accounts, legal systems you don't understand, and developers who disappear into the desert with your money. You're not going to want to miss that disaster. San Francisco startups aren't investments. They're donations to other people's lifestyles. The sooner you understand that, the more money you'll keep.